Welcome. Today we're diving into the world of depository systems in India. If you've ever wondered how your shares are kept safe and transactions are made seamless, this video is for you. We'll break down what a depository is, why it matters, and how it has revolutionized the way securities are handled. Let's start by understanding the basic concept of a depository and its role in the financial ecosystem. Depository is essentially a place where securities like shares and debentures are stored for safety and easy transfer. Think of it as a bank, but instead of holding your money, it holds your investments in electronic form. This system makes buying, selling, and transferring securities much more efficient and secure, eliminating the risks associated with physical certificates. Under the Depositories Act, 1996, a depository is defined as a company registered under the Companies Act, 1956, and granted a certificate of registration by SEBI. This legal framework ensures that only authorized institutions can operate as depositories, providing a layer of trust and regulation for investors. Main function of a depository is to dematerialize securities, which means converting physical certificates into electronic records. This process not only makes transactions faster but also reduces paperwork and the risk of loss or forgery. The depository also facilitates the transfer of ownership through simple book entries. There are four main players in the depository system: the depository itself, participants, beneficial owners, and issuers. Each has a unique role, ensuring the system runs smoothly and securely. Let's take a closer look at each of these roles and how they interact. The depository acts as the custodian of securities, holding them in electronic form. It is the registered owner for the purpose of transferring ownership but does not have voting rights or other benefits. Its main job is to keep your investments safe and facilitate smooth transactions. Participants act as agents of the depository. They serve as the bridge between the depository and the investors, maintaining records and ensuring all transactions are properly recorded. Both depositories and participants must be registered with SEBI, which ensures the system's integrity. The beneficial owner is the real owner of the securities. Their name is recorded with the depository, and they enjoy all rights and liabilities associated with the securities. The depository system ensures that the beneficial owner's interests are always protected. The issuer is the company that issues the securities. It keeps a register of all registered owners and works closely with depositories to update records and ensure accurate ownership information. This coordination is crucial for the smooth functioning of the securities market. India has two main depositories: National Securities Depository Limited (NSDL) and Central Depository Services India Limited (CDSL). NSDL was promoted by IDBI, UTI, and NSE, while CDSL was promoted by the Mumbai Stock Exchange and several major banks. Both play a vital role in the Indian securities market. India chose a multiple depository system to ensure competition and efficiency. With the vast size of the market, a single depository would struggle to handle all transactions. Multiple depositories also help keep costs down and services reliable for investors. The depository system offers several benefits to investors. It eliminates bad deliveries, reduces risks like loss or theft of certificates, and cuts down on paperwork. Investors also enjoy faster settlement cycles, immediate transfer of securities, and quicker realization of sale proceeds. Additional benefits include faster disbursement of rights and bonus shares, exemption from stamp duty on electronic transfers, and regular status reports on holdings. All these features make investing through a depository system more convenient and secure. Dematerialization is the process of converting physical share and debenture certificates into electronic form. This makes managing investments easier and reduces the chances of forgery or fraud. In India, NSDL and CDSL are authorized to handle dematerialization. Rematerialization is the reverse of dematerialization. It allows investors to convert their electronic holdings back into physical certificates. This process is more complex and is usually chosen to avoid maintenance charges on Demat accounts with very few shares. Dematerialized shares have no distinct numbers and all transactions are electronic. Rematerialized shares have unique numbers and transactions are physical. Demat accounts are maintained by depository participants, while remat accounts are managed by the company. Demat is easier and more common, while remat is complex and rare. To start business, a depository must meet several requirements: a net worth of at least Rs. 100 crore, approved bylaws, secure data systems, and proper backup facilities. SEBI ensures these standards are met before granting a certificate of commencement. SEBI's regulations ensure that depositories operate transparently and securely. They must pay registration fees, comply with all laws, and focus solely on depository activities. Sponsors must hold at least 51% equity, and no participant can hold more than 5%. Depositories are required to address grievances from participants and beneficial owners within 30 days. This ensures that any issues are resolved quickly, maintaining investor confidence in the system. Depositories must enter into formal agreements with participants who act as their agents. Investors also sign agreements with depositories through participants to avail services. These agreements ensure clarity and accountability for all parties. When investors want to use depository services, they must surrender their physical certificates to the issuer. The issuer cancels these and updates the depository as the registered owner. The investor is then listed as the beneficial owner. Depositories handle the transfer of securities upon receiving instructions from participants. If a beneficial owner wants physical custody, the depository informs the issuer. This flexibility allows investors to choose how they want to hold their securities. All securities held in a depository are in fungible form, meaning they are interchangeable and not identified by unique numbers. This makes trading and settlement much simpler and more efficient. While the depository is the registered owner for transfer purposes, the beneficial owner retains all rights and benefits, including dividends and voting. The depository cannot exercise these rights, ensuring investors remain in control. Every depository maintains a detailed register and index of beneficial owners, following the guidelines of the Companies Act. This ensures transparency and accurate record-keeping for all securities held electronically. Beneficial owners can pledge or hypothecate their securities with the depository's approval. This allows investors to use their holdings as collateral for loans or other financial arrangements, adding flexibility to their investment strategy. Depositories regularly share information about transfers and holdings with issuers, while issuers provide relevant records to depositories. This ongoing exchange keeps all parties updated and ensures the accuracy of ownership records. If a beneficial owner wishes to opt out of the depository system for any security, they can do so by informing the depository. The depository updates its records and notifies the issuer, allowing the investor to regain physical certificates if desired. Depositories are required to indemnify beneficial owners for any loss caused by their negligence or that of a participant. If the loss is due to a participant, the depository can recover the amount from them. This provides an extra layer of security for investors. Depositories must have robust systems for daily reconciliation of ownership records with issuers and participants. Internal and external monitoring, including annual inspections, ensure that controls and safeguards are always up to date and effective.